At the heart of. Serve as. Intermediary. Borrower. Deposit. Loan. Generate. Revenue. Charged on. Interest. Depositor. Availability. Credit. Expand. Stability. Inflation. Interest rate control. Facilitate. Capital flow. Boost. Investment. Activity. Banks are at the heart of the modern economy, serving as intermediaries between savers and borrowers. When people deposit money into banks, the bank uses these funds to provide loans to individuals and businesses. This system allows consumers to borrow money for things like buying homes or starting businesses, while banks generate revenue from the interest charged on those loans. The bank also pays interest to depositors, encouraging people to save. The availability of credit is essential to economic growth, as it allows individuals and businesses to expand. Central banks play an important role in regulating the banking system, ensuring stability and managing inflation through interest rate control. A healthy banking system facilitates capital flow, boosting investments and economic activities. Stocks. Financial instruments. Represent. Ownership. Company. Individual. Purchasing. Portion. Profits. Dividends. Supply. Demand. Reflect. Expectations. Issue. Raise. Capital. Expansion. Investors. Potentially. Growth. Risks. Fluctuate. Factors. Performance. Economic. Sentiment. Invest. Vital. Wealth. Allocation. Stocks are financial instruments that represent ownership in a company. When an individual buys stocks, they are essentially purchasing a portion of the company, and in return, they may receive a share of the company's profits in the form of dividends. The stock market is a place where stocks are bought and sold, and prices are determined by supply and demand, which in turn reflects the company's financial health and the market's expectations. Companies issue stocks to raise capital for business expansion, while investors buy stocks to potentially profit from the company's growth. However, the stock market is not without risks. Stock prices can fluctuate widely depending on various factors such as company performance, economic conditions, and investor sentiment. Despite the risks, stock investing is a vital part of wealth building and capital allocation in the economy. Loans. Credit. Financial. Individuals. Access. Funds. Currently. Borrower. Take out a loan. Receive. A lump sum. Lender. Repay. Interest. A specified period. Period. Rates. Reflect. Vary. Credit. Worthiness. Borrow. Goods. Services. Responsible. Essential. Maintain. Debts. Instability. Harm. Ratings. Loans and credit are financial tools that allow individuals and businesses to access funds they do not currently have. When a borrower takes out a loan, they receive a lump sum of money from a lender, which they must repay with interest over a specified period. Interest rates on loans reflect the cost of borrowing money, and they can vary depending on the type of loan and the borrower's creditworthiness. Credit, on the other hand, is the ability to borrow money or access goods and services with a promise to pay in the future. Credit can come in various forms, including credit cards, lines of credit, and personal loans. Responsible management of loans and credit is essential for maintaining a healthy financial life, as failing to repay debts can lead to financial instability and harm credit ratings. Be responsible for. Maintain. Financial stability. Core function. Supervise. Adjust. Interest rates. Lender. Last resort. Crises. Liquidity. Prevent. Collapse. Stabilize. Currency value. Severe. Recession. Central banks, such as the Federal Reserve in the United States or the Bank of Korea, are responsible for regulating a country's money supply and maintaining financial stability. Their core functions include managing inflation, controlling interest rates, and supervising the banking system. By adjusting interest rates, central banks can influence economic activity. Lowering rates encourages borrowing and investment, while raising rates can slow down inflation. Central banks also act as lenders of last resort during financial crises, providing liquidity to the banking system to prevent a collapse. They play a key role in maintaining the economic environment necessary for growth by stabilizing the financial system and managing currency values. Without the effective management of a central bank, economies could face uncontrolled inflation, severe recessions, or even financial crises. Offer. Stock. Bond. Mutual. Varying level. Risk and return. In contrast. Risk tolerance. Investment. Diversification. Asset. Reward. Result in. Substantial losses. Assess. Time horizon. Risk appetite. Investing in financial markets offers the potential for wealth building, but it also comes with risks. Different types of investments, such as stocks, bonds, and mutual funds, come with varying levels of risk and return. Stocks, while offering higher potential returns, also carry the risk of significant losses if the market or a company underperforms. Bonds, in contrast, are generally safer but offer lower returns. Understanding one's risk tolerance is crucial in choosing the right investments. Diversification, or spreading investments across different asset classes, helps to reduce the overall risk. While higher-risk investments can offer greater rewards, they can also result in substantial losses. Therefore, investors must carefully assess their financial goals, time horizon, and risk appetite before making decisions. Interest rates. Take out loans. Purchases. Expansion. Conversely. Adjust. Monetary policy. Maintain. Stability. Dampen. Excessive. Inflation or deflation. Stabilize. Interest rates are one of the most powerful tools used by central banks to regulate the economy. The rate at which borrowers pay to borrow money affects everything from consumer spending to business investment. When interest rates are low, borrowing is cheaper, encouraging people to take out loans for big purchases like homes or cars, and businesses to invest in expansion. This drives economic growth. Conversely, when interest rates rise, borrowing becomes more expensive, which can slow down consumer spending and business investments. Central banks adjust interest rates as part of monetary policy to maintain economic stability, control inflation, and encourage or dampen economic activity. By managing interest rates, central banks can help prevent excessive inflation or deflation and stabilize the economy. Bonds. Debt instruments. Corporation. Entity. Raise capital. Essentially. In exchange for. Maturity date. Compared to. A priority claim on. Asset. In case of. Bankruptcy. Creditworthiness. Generate. Steady income. Portfolio. Diversify. Yields. Bonds are debt instruments used by governments, corporations, and other entities to raise capital. When an investor buys a bond, they are essentially lending money to the issuer in exchange for regular interest payments and the promise of getting back the original investment at the bond's maturity date. Bonds are considered lower-risk investments compared to stocks because bondholders have a priority claim on the issuer's assets in case of bankruptcy. However, they are not entirely risk-free, as factors like changes in interest rates or the creditworthiness of the issuer can impact their value. Investors use bonds to generate steady income, reduce risk in their portfolios, and diversify their investments. Government bonds are typically seen as the safest, while corporate bonds carry higher yields but more risk. Financial markets. Venues. Trade asset. Currency. Commodity. Raise capital. Issue stocks. Bonds. Provide a with B. Opportunity. Earn returns. Determine. Asset. Supply and demand. Serve. Purpose. Secondary. Securities. Efficiency. Liquidity. Financial markets are venues where buyers and sellers trade assets like stocks, bonds, currencies, and commodities. These markets are crucial to the global economy because they allow companies to raise capital by issuing stocks or bonds, and they provide investors with opportunities to earn returns. Financial markets also help determine the value of assets through supply and demand. There are several types of financial markets, including stock markets, bond markets, and commodities markets, each serving a different purpose. In addition, there are also secondary markets, where securities are traded after being issued. A well-functioning financial market promotes capital efficiency, liquidity, and economic growth by providing businesses with the funds they need and offering investment opportunities for individuals. Stability. Integrity. Fraud. Manipulation. Failure. Enforce. Protect. Maintain. Fair competition. Proper reserves. Sound. Reduce. Bankruptcy. Prevent. Crises. Confidence. Transparency. Accountability. Financial regulation ensures the stability and integrity of the financial system. Without regulation, the risk of financial fraud, market manipulation, and systemic failure increases. Regulatory bodies like the Securities and Exchange Commission, SEC, in the United States and the Financial Services Commission, FSC, in Korea enforce rules designed to protect investors and maintain fair competition. Regulations also ensure that financial institutions maintain proper reserves and follow sound business practices to reduce the risk of bankruptcy. A strong regulatory environment prevents financial crises, builds investor confidence, and supports the sustainable growth of markets by ensuring transparency and accountability in the financial system. Virtual currency. Security. Traditional currency. Peer-to-peer networks. Transactrian. Pose risk. Volatility. Oversight. Illicit activity. Nevertheless. View A as B. Disruptive technology. Evolve. Remain uncertain. Cryptocurrencies, such as Bitcoin and Ethereum, are digital or virtual currencies that use cryptography for security. Unlike traditional currencies, they are not controlled by any central bank or government. This decentralized nature allows cryptocurrencies to operate on peer-to-peer networks, giving users more control over their money and transactions. While cryptocurrencies offer potential benefits such as lower transaction fees and greater financial privacy, they also pose risks. Their volatility, lack of regulatory oversight, and potential for misuse in illicit activities are concerns. Nevertheless, cryptocurrencies are viewed as disruptive technologies with the potential to reshape the financial system. As blockchain technology evolves, cryptocurrencies may play an increasingly important role in global finance, although their future remains uncertain.